My name is Aaron, and we're going to be covering the adjustments and itemized deduction for the advanced level certification. Here we will be talking primarily about self-employment tax, which we have previously covered under the income section, qualified business income deduction, as well as itemized deductions. So, for adjustments. Adjustments can be found on Schedule 1, lines 11 to 26. These are deductions that anyone can take. Some example of adjustments that people may be eligible for is the self-employment tax. Again, this is considered at the advanced certification level, and we have gone over this previously, but just to reiterate, half of the self-employment tax that a person might pay is automatically entered as an adjustment, as in will be excluded from their total income for federal income tax purposes. This can be found on line 15. Next would be the IRA deduction. For any contributions you have towards an IRA, specifically a traditional IRA, can be considered as an adjustment. This can be found under line 20. Self-employment health insurance is also considered an adjustment and is found on line 17. And previously, we used to have moving expenses that you can claim as an adjustment. However, that is considered out of scope for VITA program. And remember, income minus adjustments gets us to the AGI, the adjusted gross income. As a refresher, this is where you'll be putting in any adjustments. It's under the deduction section, but you just click that and it'll bring this up, which has a whole bunch of adjustments that someone might be able to take depending on their situation. So, what's the purpose of adjustments? Pretty simple. It's to lower your gross income and get us to the adjusted gross income. By having more adjustments, that helps lowers your tax. Once we have the adjusted gross income, that's where we'll generally start to apply either the standard deduction or the itemized deduction. But before that, we can talk about the qualified business income deduction. The qualified business income deduction is up to 20% of the total income made for sole proprietors. In an attempt to reduce fraud and make the itemizable business expenses a simple process, the IRS now allows up to 20% of business income as a deduction. This qualified business income deduction does not go on to Schedule C because the Schedule C is not affected by this deduction and the self-employment tax is not affected by this deduction. Again, this deduction is specifically to affect federal income tax. The qualified business income deduction is in addition to the standard or itemized deduction. And again, the TaxSlayer software will take the 20% automatically if the client is eligible, and it is found on the 1040, page 1, line 13. Going on to standard versus itemized. Just as a refresher, the standard deduction is a flat predetermined amount based on filing status as well as age. And for itemized deduction, it depends on various expenses, stuff like medical expenses or even mortgages. This is figured out on the Schedule A, and you need to be at the advanced level certification in order to help with itemizable deductions. I will not be going too in-depth into the standard deduction because we should have already covered this as part of the basic training. But on the itemizable deduction sides, we have medical and dental expenses, state income taxes or sales tax, property tax, charitable donations, mortgage interest, tax preparation fees, losses from gambling, only up to the amount of winnings, casualty or theft losses, which are considered out of scope. When it comes to deductions, at the end of the day, it's a taxpayer's choice on which one they want to take, standard versus itemized. We can advise them to choose which one is higher because that'll help lower their total tax. And as a general rule of thumb, the higher the income, the higher the chances are that the taxpayer should itemize. Above, we have two different examples on when someone should take a standard deduction and when someone should take an itemized deduction. But again, generally, you would want to take the higher deduction because that will help lower your total tax. Itemizable deductions can be found on Schedule A, and anything that you put into TaxSlayer for itemized deduction will be transferred over to this form. As you can see, there's a section for medical and dental expenses, taxes that someone might have paid, interest someone might have paid, as well as gifts to charity. You may be wondering as to what sort of itemizable deductions a taxpayer might have, and this is where we tie it back into the intake form. This would be page 3 of the intake for 2024, and at the top here, you'll see that this section relates to expenses and tax-related events. Most, if not all of these, are pertaining to either adjustments or itemizable deductions. If there is a checkbox here, please keep an eye out because it may turn out that the client might be able to take an itemized deduction over a standard deduction. In order to put in itemized deductions, you can find this under the Deductions tab, and you will be needing to go into itemized deductions specifically. Once you go in there, you'll be able to see the type of itemizable deductions you can claim. To go more in depth into itemizable deductions, let's first start with medical expenses, which can be found on Schedule A, line 1. The total amount of medical expenses must be more than 7.5% of the adjusted gross income. Otherwise, you would not be able to include it as part of an itemizable deduction. The expenses are eligible for both tax filers, so taxpayer and spouse, as well as any dependents they may be claiming. This includes medical, dental, non-prescribed medicine, as well as vision expenses. However, this does not include vitamins or cosmetic medical care. There is a unique deduction as part of medical expenses where you can include the mileage driven to receive medical care and medical education programs. For tax year of 2024, it is calculated to be 21 cents per mile. This needs to be for amounts that are paid by clients out of pocket or with loan or credit. If they received it for free and did not pay for it out of pocket, unfortunately, you would not be able to claim that as a medical expense. TaxSlayer will automatically take the deduction if it exceeds 7.5% of their AGI. Moving forward, for sales and local taxes. So, sales tax or state income tax, otherwise also known as SALT taxes, can be found on Schedule A, line 5. TaxSlayer will use whichever of the following is higher. State income tax, which refers to state income tax withholdings, estimated tax payments to the state, or other tax payments to the state. Or sales tax from all purchases or large purchases, like a car or a boat. However, state and local taxes and property taxes are capped at $10,000. Moving on to deductions for property tax. Real estate from the 1098 mortgage interest form or a county assessor bill, specifically line 8. The DMV license fee, remember just the license fee, which can be reported on line 5C, as well as any other property taxes that might be paid. For people who are paying property tax, generally that'll be reported on Form 1098, the mortgage interest statement. On there, the things that we would be able to claim is the mortgage interest received from the payer or borrower, as well as any real estate tax. If clients don't have that knowledge on the top of their head, they can also look it up at the tax site. For LA County, that would be the following website, maps.assessor.lacounty.gov. If you do have a Form 1098, simple. You just need to go to that form on TaxSlayer. If there was any real estate taxes paid that was non-business property, this is where you would be putting it in. And going back to the form, in this case, we had mortgage interest as well as mortgage insurance premiums that was paid. Not just that, we can also include interest that was paid as well as paid points. However, HOA fees and home and property insurance is not eligible to be considered a deduction. You'll be putting in the mortgage interest that was reported in the Form 1098, specifically the interest paid, as well as points paid here. Moving on to charitable donations. So charitable donations will be reported on the Schedule A, lines 11 through 13. You must have a written record for deductions above $500. This must be donations to a nonprofit or a charitable organization. And if anything, you can find a list of all organizations that can receive a tax-deductible charitable contribution at an IRS website. If you are driving in service for a charitable organization, you can take 14 cents per mile. If the total charitable contribution is more than 20% of a person's AGI or a taxpayer's AGI, you might only be able to take a percentage of that contribution, with the unclaimed amount being carried over to the next year. That specific percentage does depend on the type of contribution and the type of charitable organization. But generally, cash contributions to qualified organizations has a 60% limit of their AGI. Please remember to list each donation separately on the worksheet. This is where you'll be putting in gifts to charity. And as you can see, cash gifts, non-cash donations, limitation on charitable contribution deductions. There are different sections here. However, for most of the time, it'll either be cash gifts to charity or non-cash gifts to charity. So going under charity cash contributions, I do know that there is an override button where you can lump everything all into one. I do not recommend doing that, primarily for clarity reasons. If everything gets lumped up into one, the taxpayer as well as the IRS might not understand where this total amount is coming from. So please list them all individually. You will need to put in the charity's name, the description, the date of the donation, and the total amount donated. Going on to miscellaneous deductions. Unfortunately, most miscellaneous deductions can no longer be claimed unless under specific circumstances. Miscellaneous deductions include work-related expenses, which used to include job search, gifts, union fees, uniform fees, home office, as well as mileage, tax preparation fees in 2024, cost of a safety deposit box, legal fees related to producing or collecting taxable income, or fees used to collect interest and dividend. Those are all cannot be claimed again unless under specific circumstances. However, if you are within the state of California, please still include all of these on the return because, if anything, this is one of the nonconformities that the state of California has compared to the federal tax law, as these can be included on the state of California's itemizable deductions. Just to hammer it in again, when it comes to standard versus itemized deduction, ultimately it is the taxpayer's choice. We can advise the taxpayers of the implication of taking the lower deduction, and generally, the higher the income, the higher the chance that the taxpayer should itemize. Again, you do generally want to take the higher deduction. On the left, you'll see the total amounts of standard deductions depending on filing status. And on the right, you'll see a list of the itemizable deductions. Generally, you want to take whichever one is higher. That's it for the itemizable deductions as well as adjustments and qualified business income deduction. Next, we'll be going over credits and other taxes for the advanced level certification.